starting. All attendees are in listen-only mode.
Hi, everyone. This is Ashley Simpson. I'm going to be moderating the webinar today, but we are going to give it just another minute. Looks like we've got a bunch of people jumping on right now, so I will give it just another 30 seconds, and then we will get started. All right, let's go ahead and get started today. So I am very excited for everyone to join us today. We are going to be talking about holistic planning. On the line today as your speaker, I have Tom Bacharach, who is our Regional Vice President of the Northeast. He kind of goes all over the country when there's not a pandemic going on, but right now he's kind of stuck up in his just one little area. So today he's going to be talking about holistic planning. Tom handles just about everything within our company. So he's going to be talking about all the different areas of our business and how those things can really help you create some opportunities with the business owners that you work with. So Tom, I will go ahead and hand it over to you.
Well, thank you, Ashley, and I appreciate that. While I'd like to say that I'm not stuck in the Northeast, the reality is, yeah, I'm kind of stuck in the Northeast. That way I don't have to, anyways. Enough pandemic discussion. I think people are a little burnt out on that, so we want to talk about something a little bit more fun today. And just as a matter of note, neither President Trump nor Joe Biden have approved this message. Anyway, so let's go ahead and get started. So as the discussion says, we're going to be solving business owners' needs and doing it through holistic planning, which is a really nice way of saying we can do a lot for most every business owner that's out there. And there's an old axiom in business and in sales specifically, and it says, don't ever leave anything on the table. My hope is by the end of this conversation, you're not only going to have a way to pivot to get more off of the table, what you're going to realize is that RMC can actually give you the table itself. So having said that, let's go ahead and get started. Hold on. Okay, there you go. That's me, and I'm sorry that I've got a face for radio, but that's why this is going to be so exciting. All right, so moving on. What is risk management? Well, there's a lot of different ways that you can cut that up, but really risk management, whether it's living too long, retiring too early, having the coverages that you need, is really the ability to optimize the revenue that you spend on insurance and for risk. Are you getting out of it everything that you should? Because risk isn't a bad thing. Most people, when they think of risk, they think of downside and protection, but risk also gives you the opportunity for reward. So are you working with a group of individuals? Are you working with business owners that are willing to accept a little bit of risk for substantial reward? And what we'll do through this hour or so is give you some highlights on some areas that we can help with that risk management. Knowing that, you look at what a business owner has and the things that they're concerned about. And to a large extent, also the areas in which they're expending that needed capital. Areas such as their property and casualty, the medical and health and their benefits. Those are really the big two outside of your payroll. Are they doing appropriate business planning? Are they spending their life working for their business, or do they have their business working for them so they can spend their life? Are they efficient in their business operations? Or as they've grown, have they really just kind of kept themselves in a position where they put people that, while not necessarily qualified, have been there the longest, so they've assumed the mantle? Can we help them with that? And then retirement planning. Obviously, the goal for everybody is to either retire comfortably or at least have the option to retire. And we want to be able to give you some options in that as well. And then finally, risk management in total. And so when you look at that, and you've got the client in the middle, what is it that RMC can offer? Well, if we move to the next slide, which is a lovely slide we call the Mickey Mouse slide because of the years, we look at the property and casualty solutions. Not only can we write directly for commercial and personal business, we can do it in such a way that is utilizing both national and international brokerage outlets to be able to bring you those opportunities and products that are best suited for that environment. With the medical and health solution, those benefits, while it can be very political to talk about the ACA and all the different options, the reality is we're trying to make it more affordable for that business owner and really give that business owner options that can maximize what that employee is trying to accomplish through their own healthcare, whether it's coverage or cost or a combination of both. And you can do that using stop losses and self-insured type of plans, and we'll get into that in a little bit today. Are they using their business planning solutions either through life and annuity? Are they talking about a buy-sell? Do they have business succession planning? These are all things that we can assist with. With regards to the business and operations, are they most efficient using their payroll? Do they have a human resource person that is there by default, or is a true professional? And do they want to possibly outsource that to make sure that things are being done in the most appropriate, regulated, legislated manner so that we do it appropriately? And then in the retirement solutions, while it can be very vogue and everybody knows about a 401k or a defined contribution plan, does everybody know what a defined benefit plan? And is that something that we can give a business owner that helps them optimize not only their retirement goals and plans, but also give them an effective tax strategy that can hopefully reduce some of their tax bite at the end of the year? And then in the overarching look of risk management, are we looking at ERM, which is short for enterprise risk management? Is it appropriate to have those discussions? Most agents, most property and casualty agents will look at that and say, well, what are the risks? But are they really looking at the risks? Risk is more than just, having an auto accident. Risk is also, should you have one or two plants instead of just one, for decentralizing that risk? So there's lots of things that we can discuss with them. And then finally, one of the discussions we'll be having today is it appropriate for the use of a wholly owned, individually owned life insurance or insurance company for the benefit of the parent company? That's called a captive. So one of the things we like to do very early on is look at what those risks are. What is your circumstance? Can we give this business owner, this client, a risk physical or a comprehensive risk review? In order to do that, we're going to need to collect significant data points and information. But what that's going to be able to do is give us a better understanding to the value that we can bring to our clients. Imagine, if you will, being able to go back to a business owner and being able to say, instead of walking in and saying, this is what I have to offer, by doing the comprehensive review, you can help them establish, they can help you tell you where their pain is and give you the ability in 1, 2, or 3 areas to be able to pivot to those areas that they have the most need in first, and then get to those areas that they want to help have solved, or may not even know that they have a need for later on, once you've saved them money, shown them value, and give them cost-saving opportunities. So that's what a comprehensive review can do. What we're going to need in that circumstance is pretty much the information that is going to identify those areas that that business has or has not covered. Can we look at their commercial policies? Can we get a copy of their employee census? And that's going to be important because it's not only going to tell us the demographics, but it's also going to say, where are people located? It's going to be a very different conversation if we've got a manufacturing plant with 30 employees in New Jersey versus a distribution sales center that is national in scope. And that's going to help us to understand more about what their specific needs are. And that's going to help to be able to come back with options, not coming back with a singular plan, giving them options and being able to establish that value. What are the future plans? Just because we have an opportunity to establish information doesn't necessarily mean that that business owner is ready for a variety of different reasons to move forward with those plans. Can we lay out a 1-year, 3-year, 5-year, 7-year strategy to put in different concepts, different efficiency methods that is going to help either grow or maintain that business in the way that that owner wants, in the way that the stakeholders want? And we do that by a variety of questionnaires and a feasibility study if necessary. We're also going to need to know what has happened in the past, both good and bad. And so a large part of the time we're going to ask, what are your large losses? What does your claim history look like? So that's a risk review. All right. One of the largest expenditures that goes out with regards to benefits are medical plans. One of the plans that we are very, very strong and very proud of are self-funded plans. And the way that I can explain a self-funded plan is this. I'm actually going to move on. You have fully insured and self-insured. What option does this client have? Do they know? Are they sure? Have they had this discussion? A fully insured plan, Blue Cross Blue Shield, Cigna, Aetna, those type of opportunities where the client, the business owner, and the employee have to do relatively little. All they pretty much just do is show up and show their card, maybe their pharmacy card, all claims, everything is taken care of. And there's not a lot of information that is shared between the insurance company and the insured or the or the employer because they're fully insured. They're not that transparent, and they don't necessarily show a lot of what their claims are doing. It gives you a great convenient way, but it's not truly efficient in the way that it's done because you're paying somebody to do everything and have you do nothing. If you're willing to put a little bit of effort into it, maybe do a little of accounting, maybe look at a spreadsheet on an occasion, you can be more efficient. So fully insured says, I want to pay a larger premium for the convenience of having to do nothing. But if you're willing to go self-insured, the way that I can explain it is this. Let's just pick a number and say that an employer has 50 employees, and they're paying roughly $1,000 a month for each. So that $50,000 a month equates to being $600,000 a year. Probably not that far off on many of the plans that you're looking at. So a fully insured plan is going to cost you $600,000 a year. And you don't care what happens with the claims. You don't care once you meet your deductibles, that's fine. But imagine, if you will, you've got a younger crowd or a healthier crowd or people that have other opportunities that are making you a better than average or exceptional risk. Then self-insured may make a little bit more sense, because imagine if you paid $600,000 in premium for your insurance, but you've only paid out $250,000 in claims. That means that there's underwriting profit of $350,000 that was left at the insurance company. Why not put that in the hands and the control of that business owner using a self-insured type of option? The other thing that you need to be aware of, because we've talked about fully insured now with self-insured, Self-insured is you're going to pay claims. You're going to have a top hat on it that is going to prevent you from the catastrophic losses. But you're going to pay claims as you're going along, which means that there can be fluctuations. If you want a little bit more control, like you have in a fully insured plan, when you know what those costs are, then an option that may be suitable for you is what's called a level payment option. And that level option is much like, I use the example that my heating bill, because I live in Connecticut, is nothing in the summer and extremely high in the winter. So I'd rather pay the same amount each month because I can now have a level billing premium, very similar to the same type of understanding of what a level premium option can be in the health insurance option. But these are opportunities, both in the level premium and the self-funded plan, that give you significant more control, not only in your cost measures, but your efficiency measures, more risk management, more transparency, and at the end of the day, more cost efficiency, because you can design these plans the way that you want. One of the things we do have to realize, though, is with these type of plans, we have to provide to that business owner, that client, that end user, those group of employees, a plan that, while it may be different in structure, appears to them to be substantially similar to the way that they are used to it. People are used to having their fully insured plan, and if they're concerned that it's not going to operate the same way, they're probably never going to move in that direction. So it's up to us to design this with those options that they want, with greater flexibility of option, but have it given to them in a way that they understand that there's no real difference. It's still picking up the phone and making sure, if you were going to call Travelers or Unum or whomever, it's the same type of thing. Now you're just going to be calling RMC or your third-party administrator. No real difference to that. All right, so really, what does this mean in the bigger picture? Well, a fully insured plan typically go up in cost every year, and they can be very expensive. In this example, I think example was for a 125-person group. And in 2000, and I believe this was 19, their fully insured plan, which was Blue Cross Blue Shield, was going to be about $1.2 million a year, $1,185,000. Their renewal, although they had a good year, but it didn't really matter because the fully insured carriers don't tell you what their pricing is. There was going to be an increase of what? $180,000. No real changes. But if we move to a level funded plan, you saw a slight reduction or a savings immediately of about $125,000. If you then decided, okay, let's look at a self-insured, fully self-funded plan, you'll realize that there's a difference in premiums. They're estimating costs because this is cost containment and efficiencies. There's some administrative costs and some vendor costs. But in this circumstance, because you got to control it, because you were being a little bit more efficient, you saw an immediate savings of $473,000. In a perfect world, most people would say that's great. But again, part of what our responsibility is to look at those business owners and say, are you taking advantage of these? What is your pain point? What is going to make that decision? Because while in this circumstance, we see a savings of almost $500,000, it doesn't necessarily mean that everybody's going to move. And let me explain. We had a circumstance about a year or two ago, actually a little bit more than a year ago, where came in was going to show probably about a $700,000 savings for a business owner. But the business owner didn't want to move because he was so used to his fully insured plan, and he had had a bout of cancer and was so impressed with the network and the insurance company and how well they treat him that he never wanted to leave that company. while I appreciate the loyalty, there are things that we can do to make sure that they're using similar networks. And that's part of the design and the implementation of what a fully insured or a level funded plan or a self-funded plan can do. It gives you better design options than what you may just have with a fully insured plan. So what we need just to kind of figure out what these proposals are going to look like is, what the estimated enrollment is. Just because you've got 135 employees doesn't mean that you've got 135 employees on a plan. You're going to have some that are employees and some that are families. You're going to have some that waive out because they're being covered other places. So part of this is also understanding how many covered employees that we're going to have. What is the claims experience for 2 years or so? Did you have any huge claims? Did you have, the person that had a brain tumor that had to be removed, or a difficult pregnancy? Those are large claims. What does your current plan look like? And what are your current rates? And what we like to do in this circumstance is actually get on a call with you and your end user, your business owner, and say, what do you like about your plan? What do you not like about your plan? What would you have added? And so we do that as a discovery call. And then what's really important for our underwriting purposes is, what are we looking at as far as what is that renewal for that upcoming year? What is the bogey that we've got to hit? Because we want to be able to show cost efficiencies or better benefits and or both. So that's where we start. All right. So do we have any questions at this point?
We do. So one of the questions we have is, where did it go? Why don't more employers adopt a self-funded plan?
Because it's new. Yeah, I mean, it's a great question, and that gets to kind of the heart of what we were talking about before. It's new, it's different. They haven't heard of it. A lot of times, an advisor may not be in that arena, so if they don't know about it, they'll poo-poo it. Or a lot of the time, one of the greatest centers of influence that we have are CPAs, and a lot of times a CPA may not have an understanding of it. So part of our responsibility is, like I said, let's make it look so that it's substantially similar, because if it's going to be really different, people don't like different.
Right.
Change is a hard thing. So, okay.
Makes sense. All right. Thank you.
All right. So the next item that we're going to be looking at is property and casualty. Again, another one of the largest expenses that a business owner is going to have or run up against in this circumstance. And it's that property and casualty that are ways. Now, where this becomes really important and really topical right now is because of COVID-19. It has exposed areas with traditional property and casualty carriers that they are increasing premiums and making it a little bit more difficult. And what that is referred to in insurance parlance is a hardening of the market. This is a little bit overdue. We've been waiting on it for a couple of years, but this kind of expedited the process. And what we're seeing is substantial increases in general liability or the excess market. It's not uncommon to see increases of 20, 40, 60, 80% on the premiums. So for those of you that are excited that Allstate and Liberty Mutual and all the other companies are saying we're going to give you some money back, they're not really giving you anything, because they're about to hand you a larger bill because expectations are not the same, and it's going to get a little bit more difficult. What I mean by that is, I'll give you a very real example. I have a circumstance right now where it's a contractor in New York that last year his general liability coverage that he needed was $2 million of a base policy, and he needed another $8 million on liability. So he needed a total of $10 million worth of liability. And what happened was, because of the pandemic, that $2 million and $10 million, which was costing him about $300,000, he got the renewal this year that they cut the insurance in half, so it's 1 million and 5 million, and increase the premium to 585,000. That's not uncommon. If you're not talking to your clients about what's happening with their commercial property and casualty, you may be missing an opportunity. What it also does is, in this circumstance, we're looking at general liability, commercial property, workers' comp. We don't know it right now if COVID is going to be considered under workers' comp. Cyber liability, probably one of the fastest growing areas of liability because of so much going on and so much commercial trade taking place on the internet. And then, of course, commercial audit. So lots of different things that you can do there. I would love to tell you that property and casualty agents, risk managers, insurance professionals are making sure that the client is being taken care of in every turn. But just like anything, just like any industry, you're always going to find things. And one of my favorite examples, and one of the reasons why we like doing a comprehensive review, is because I was down in New Jersey probably about 3 years ago at this point now. And I walked into a gentleman's office that did auto transportation. And what he did was he took specialty cars and antique cars all over the United States to the different auctions. And so we did a lot of transportation. And when we were talking, he said, sure, you can quote on my auto coverage, but you're never going to beat it. People have been trying to beat it for 10 years. And I said, okay, let me see the policy. And he was a little taken back that I said, see the policy. And I said, no, I need to actually see what the policy is so that I know what I'm competing against. And so I came back in 4 days and I sat down with him and I said, you're right, I can't beat this and nobody can beat this. Would you like to know why? And he said, well, sure. And so I said, flip to page 4, and I had highlighted where it said, as an exclusion, he was prohibited against the transportation of specialty and antique cars. So that wonderful rate that he had never applied because he was paying for coverage that didn't cover him for anything. That happens more often than I would like to admit. And so by doing a comprehensive review, we can do a deep dive into what they have and start with the concept of this for your client. Let's give you some value so that we explain exactly what you have. Because how many times have business owners just kind of let it go on automatic pilot and said, okay, yeah, I think I'm covered for that. But they truly know what they have. And they truly know what they're paying for and where their coverages are and where they're not. And that's where a comprehensive review can help. And that's a free review that we do, because what it does is it allows us to look at areas that I would say probably about 20% of the time when we do a review, we come back and say, you know what, everything's perfectly fine. You may want to tweak this or tweak that, but there's nothing that we would change about it. And those are the best type because you're truly giving that client some value. You've given them more information and it didn't cost them anything. So it's probably going to build a little trust for you as well. So for that property review, we're going to need to see what those existing coverages are. We're going to need copies of the policies, probably a 5-year history, and then give me a write-up and have a discussion about what they're doing, what they're trying to accomplish, what coverages they have, and who are the stakeholders that might be able to help us identify some of those risks. Which brings us to our next. Now, do we have any questions at this point?
We do have one quick question, and it is, when is the best time to do one of these reviews?
Well, probably the best answer would be three months before the policies renew. Because what we need to do is have enough time to look at the policies, put them together, ask some questions, and then go out and shop the market.
Okay.
So
yeah,
about
I think that's
90 to 120 days. So thank you for that question. That helps because if you're going to come in 3 days before the renewal, there's nothing we're going to be able to do to help you.
Yeah, definitely not. All right. Thanks.
So, okay. Let me catch up. All right. So which brings us to the next. So property and casualty. and to some extent, self-insured medical, but we'll talk about that at a different point, are items that are payment items. And unless you've got a claim, chances are you're probably not getting money back. And so, Ashley, since you're on the phone, I'll pick on you. Do you have auto insurance?
Yes, I do.
Okay. How much money did you get back last year?
Well, this year, technically, I did get a little back. But typically, no, I don't get anything back.
Okay. All right. So the reason for a captive is relatively simple, although it's kind of a advanced concept. The understanding as to why and who you'd approach on it is very simply this. If I was to give you the exact same coverage that you have, or maybe improve the coverages either in the types of things that are coverage or expand the type of things that you're covered for, and at the end of the year, you got to keep 60, 70, 80% of the premiums that you're paying in, would you be interested in listening to the concept? Most people are going to say yes, and most business owners as well. There are certain things in their risk profile that are going to cause claims. There are other things that aren't. And so that can create a profit center that allows them to have control and ownership of their own insurance company. Most people will agree that insurance companies are profitable. So if you've got to pay insurance premiums, why not pay it to yourself? And so that's the basis, and that's the basic concept behind a captive. Captives have been around nationally for about 100 years. They've been really popular and grown from about 5,000 to about 10,000 really in the last 10 years. And very specifically, probably in the last 3, once the PATH Act in 2015 got rid of some nefarious activities. And that was a good thing. It helped eliminate some of the scrutiny that you see around captives. But who are we looking at when we talk about a captive? Well, the potential client, they have to be tall enough to ride the ride. So you're looking at businesses with gross annual premiums, annual revenue of about 10 million. Clearly, they're going to need property and casualty coverage because if they have no risk, there's no reason to do this. And one of the great examples of that is, I don't know if you recall Tom Clancy, but he was a very successful author worth about $300 million. He actually looking into a captive, but he had no risk, so there was nothing to insure. The reason for a captive, let me repeat this and underline this boldly, is it is for the assumption of risk and the ability to contain, control, and reinvest some of the monies that are being expended for that. While there may be some tax advantages, this is not a tax avoidance strategy and should never be looked on as such. The client should also need some risk management, and because there is a form of retention and transfer of risk that you're going to be assuming as a business owner, you have to have somebody that's, I'm not going to say, somebody with an MBA in economics, but you're going to have somebody that has the basic understanding of risk and reward. Do I want to look at this? Because if you look at what risk is, or what you have in that market, you have self-insurance, which is the ability to put away large monies so that you can take care of any claim that comes your way. You get control of that money, but you pay taxes on it, right? The other side of it is true risk transfer, which is insurance. I pay a little bit of premium to an insurance company, and if a claim occurs above my financial capacity, the insurance company comes in and pays for the claim. A captive gives you the best of both. You're not exposed completely against those large claims, but you have control over what to do with those premiums. So in this case, we have a lumber yard that had substantial revenue. I think about 25 million of revenue. when we did what's called a feasibility study, which is really the first step in captives, what that does is, after we've done the comprehensive review and we've decided, okay, there's an opportunity here for more efficiency, we're going to look at a captive. And the feasibility study is when an actuary comes in and looks at all of your risks and actually comes back and says, here is the opportunity, here are the lines of coverages that you can cover inside of your newly formed, wholly owned insurance company, and offers the structure and the pricing of those premiums, but also the feasibility study becomes the very blueprint of how we're going to create this newly formed insurance company. And so if you look at what happens, well, it ends up being about a 250-page report. We've boiled it down so that really here's all you're really looking at. In this case, there were 15 separate risks that feasibility study came up with. Things such as administrative actions, loss of key contract, loss of key customer, loss of key supplier. In this case, part of what the insurance was able to do was they had a relationship for about 60% of the wood that was supplied to the lumberyard came from a key contractor. That contractor, while they had a relationship for about 40 years, never gave more than a 30-day contract. And what we were able to do is look at it and say, okay, if they ever lost that contract, it would take about 3 years, about $5 million to replace. So we insured the contract. See, what a captive does is it gives you the ability to look at the type of risk that you have and say, if we can come up with an actuarially appropriate premium and there's an insurable risk, we can insure it. Things like political risk, regulatory risk. One of my favorite, and it's very topical right now, is supply chain or distribution risk. I had a circumstance, I want to say about 2 months ago, where I talked to a business that are supplying the PPE and gowns and masks to the Hospital Association for New York. And one of the big concerns that they had was loss of supply chain, because most of what they were importing was coming from China. And so in discussing it with them, I said, look, you can protect against work stoppage, or you can talk, if, for example, you can't, you have a circumstance where you're trying to get the supplies off of a ship at the port in San Francisco, if there's a disruption, then you can put that as a claim because that's a risk. And the person I was talking to actually started laughing and said, oh, did they already tell you that happened? And in reality, what had happened was, because of what was going on with things in the United States and the political, let's just say disruption, for lack of a better word, they couldn't get the PPE off of the ship. Actually, in San Francisco, it sat on the port for 2 weeks. Just imagine the loss of income that 2 weeks was. So those are things that can be covered that normally couldn't be covered in traditional insurance. So that's an opportunity for captive. Actually, let me go back. If you notice on this, there are different costs. The reason is because of actuarial science. We can say, this is the minimum you have to pay, or this is the maximum you can pay. And what it has is comfort of making sure that money is there in the case of a loss. So it's actuarial probabilities. So you have the ability, for the first time probably as a business owner, to massage the spend on your insurance so that you can get the most efficiency inside of that. The more you put away, the more you're going to be able to invest and use later. The lease may be a little bit more effective for those down years. So you have opportunities there. So that is a very quick overview of captive. It is not self-insurance, it's reinsurance, because it's backed by either a reinsurance arrangement or a fronting company. But if you want to have a discussion, more than willing to discuss that a little bit more. It's more along the lines of, hey, I have this company. That's where we start the conversation. Do we have any questions at this point?
We do. We have one that just came through, and it says, is a captive the same as self-insurance?
Outstanding question, and no. Self-insurance means that you're putting that money away in some type of a brokerage account, and you're spending, you are at risk completely for any claims that come in. It's 100% coming out of your pocket. In a captive, you've got a reinsurance arrangement on our smaller or micro captives or our 831B captives. We have a reinsurance arrangement that it's a 50-50 co-share with your reinsurance arrangement. So if you had a $100,000 claim, your captive would pay 50% or $50,000. The rest would go to the reinsurance arrangement and be paid out of that. So it's not self-insurance, it's reinsurance.
Got it.
Excellent. Thank you.
Who
All
knew?
right. So was there anything else?
Nope, that's it.
Okay. All right. Then I'm going to move on. And so the final portion, it really is retirement solutions. And my hope is that for most of us, this is going to be the final retirement benefit that we have, or the final benefit that we're looking at. We're all hoping for the ability to retire comfortably, or at least have the option to retire. More and more people are not retiring. They're saying, you know what, I'm enjoying what I'm doing, why don't I just continue this? And so, but what these plans can do is give you that option to either ride off into the sunset, never to be seen from again, or, you know, stay where you want. But again, it gives you the options, and that's really what we're trying to accomplish. All right, so who wants these benefits? Who's looking for these benefits? Well, in a large part of the circumstance, what we want is a small, profitable business. You know, maybe a service company. And it doesn't necessarily, it's not relegated to attorneys or doctors or CPAs. You know, you've got manufacturing companies, you've got internet companies, you've got franchises that these are going to work perfectly for. You know, they're interested in some type of retirement planning. I can't tell you how many times we've worked with CPAs, and this gives a nice deduction. And when you're talking to the CPAs or the client, you say, well, at the end of the year, you know, well, what did you do for your tax deductions for this year? And they said, well, I went out and I bought a printer or a car, which are depreciating assets. By doing this correctly, you're going to maximize their risk opportunity, give them larger tax deductions, and be able to give them an opportunity to put more money into their retirement. They may have a need for life insurance. And what they may actually do is have a need to help reduce their taxable income, because they may have an income such that it may be above what they currently need. So let's put that away for either themselves or future generations. Most people, when they think of retirement plans, and obviously the most vogue in the United States is a 401k. The challenge with a 401k is, while they are wonderful, they are something that has hampered the savings ability and the retirement planning of an entire generation, and actually now going into a second and third generation, because it's a hope. Right now, the average employee, if they put as much as they can into a 401k, are going to come up 60% short of their retirement goals and needs. Now, overlay that on a business owner that is not your average employee, is probably paying, it has more income, more assets, more ability to put things aside. And yet, if we're using a defined contribution plan like a 401k, we're treating the business owner like we're treating the receptionist. That's an unfair equation based on the amount of risk that that business owner wants. Also, the business owner may want to give benefits, may like giving benefits, but may not want to pay for the other employees. In a well-crafted defined benefit plan, you can get 65, 70, 80%, 85% going to that business owner. So after taxes, there's no net cost. So imagine being able to provide to a business owner something that's going to offer the highest tax deduction available under the current IRS laws for retirement planning. Guarantee them income that they cannot outlive. Yeah, it's your grandfather's pension. Reduce or eliminate or diversify market risk, which may or may not become more appropriate depending on who wins the election, but it takes some of that retirement income off of or out of the market. Imagine, if you will, how much more aggressive you could be in your personal investments, your other investments, if you knew you were going to have a guaranteed income of $10, $15, almost $20,000 a month guaranteed for the rest of your life. You can be a lot more aggressive. You might take that flyer on that Far East Asia pork belly derivative. So great way of helping diversify that. And then finally, but not least important, is the purchase of estate planning tools on a pre-tax basis. What this does, by using those products that are currently available in the market, it gives you a true retirement plan. And what I mean by that, well, if you look at a 401k, or a lot of the retirement plans that are out there, they're just money sitting there surrounded by a pool of attorneys. But by using estate planning tools as the funding vehicles, it may drive up additional deductions, but it's going to give you the ability to have a self-completing plan. If you don't make it to retirement, your family gets to live as though you had a retirement together. But it may also give you funds if you become chronically ill or terminally ill, or God forbid you have a need for it. If you're in, depending on the state, you may be able to have these plans set up so that there's long-term care benefits being provided as well. That's truly retirement benefit. So those are things and options that you can look at inside of a defined benefit plan. And they can be coordinated with a 401k or other types of plans. Now, I'm going to also bet that people on this meeting were born someplace other than where I was born. But I will say we share one set of values, and that is, given the choice between three piles of money when it comes to retirement, you take the larger pile. And what this illustrates is, if you look at a 401k or defined benefit plan, and this was run for a 50-year-old just using 5% returns, if you use a defined contribution plan, like a 401k or a SEP or a profit sharing plan, that person's going to get on average about $800,000 at their retirement. If we use a traditional defined benefit plan, which allows for stocks, bonds, and mutual funds, has great flexibility, but also offers no downside protection, you can get up to $2.2 million. But if we use a fully insured plan, one that guarantees the return internally and guarantees what's going to happen at that retirement, you can get up to $4.4 million. The last plan, the fully insured plan, is truly tax deduction, tax deduction, tax deduction, because it is a plan that offers the highest expenses to be able to give you the largest deductions as well. So what do we need? Well, I need a snapshot of what is this company doing? What are their goals? How many employees do we have? And if anything, do they have any existing plans in place? That's going to help me to understand how I can help you bring back the most appropriate options to the client, give you the ability to pivot just away from a 401k. So that is holistic planning. We went all the way from just giving a comprehensive review on, a company's property and casualty, some opportunities with regards to self-insured or self-funded medical plans, ways to be more efficient that way. With the use of property and casualty, how you can actually start your own property and casualty company. And then most importantly, once you put those all together, what are we doing for a client? What are we doing for that business owner to offer them the strongest options that they have for a retirement plan? So don't leave anything on the table. And in fact, if you want some help, RMC will provide the table. We just need you to find the clients. Do I have any questions at this point, Ashley?
There was a question about the retirement plans. Do you have to put all of the employees on the plan?
Wow. Okay. Great question. That is one of the biggest myths out there. You may have a circumstance where you've got 10 employees, and for the retirement plans that we're talking about probably plans that are under 20, probably 15 or under employers. You can legally carve people out by classification. What do I mean by that? Well, let's take a physician's group. You have physicians, you have physician's assistants, you have nurse, and you have clerical. So they're all different categories. You can, legally, be able to carve out a category. And the category of being old, slow, and stupid is not actually a category. They actually have to be defined as such. But you can say, all my supervisors, are ineligible. And so what that does is you can, so long as you meet basic eligibility rules, and there's 2 of them, and those are total number of employees that are eligible, and then we have to make sure that the non-highly compensated employees, a certain number are in there as well, because these are not supposed to be top heavy or discriminatory plans.
Okay.
So long as they're in there, it's not uncommon to see a total of 10 employees be eligible, but us only have to cover 4 because we had a couple owners that we could take out or a couple other people. So great question, but no, you do not have to cover the other people. The only challenge you have at that point is whoever you carved out may say, hey, why am I being carved out? And that's why you have a 401k, so that you can give them similar types of benefits. That becomes water cooler politics. But for a business owner, when you've got an older employee, it may be more beneficial to put $5,000 or $6,000 away for that person instead of $50,000 or $60,000 away.
Yeah, makes sense.
Are there any other questions at this point?
I think that was the last one. Unless anyone has any other questions, feel free to drop them in the chat. I don't see any others, so I will kind of just go ahead and wrap it up. If you want to go to the next slide, I think your contact information was on there, Tom.
Yes, it is. Actually, let's take a minute here, because these are some awfully talented people. Other than the guy with the face for radio, me, Ryan, Doug, and Mark are some extremely talented people that can help in any of these circumstances, design some pretty amazing plans that really can put some value back in for your client. And I'll let you walk it out, but let me just close by saying it's a lot of subject. I hit you with a fire hose. This is the number of presentations that I did is usually probably about a 5 or 5.5 hour seminar. And I think we did it in just about 55 minutes. So a lot to talk about, very, very high level, but I hope it piqued a little bit of interest and give you the ability to, maybe pivot instead of walking in with one option, being able to walk in with 5. So I thank you for your time. Go ahead, Ashley, take us out.
Yep. And thank you for your time today, Tom. We really appreciate you talking about these topics with us. And I'm sure everyone appreciated it today as well. So I just want to thank everyone for joining us. Keep in mind, we do have a captive webinar coming up on November 10th. And that is going to be with our newest employee, Courtney Bowles. So I'm very excited to have her join us for her first webinar with RMC. She is an expert in the captive field. She's been in the field for a while, but she is a new employee to RMC. So I'm excited to have her join us for our next webinar coming up. So keep an eye out for those emails. That is going out tomorrow about her webinar. So keep an eye out for that. But again, just thank you for joining us today, everyone.
Thank you.
Bye.